Alright gang, it's your boy Nature, aka Nature, so let's go right back into it. So margin level is your margin level, is very important. It's your equity slash your use margin times 100. So your trading platform will automatically calculate and display your margin level. But if you don't have any trades open, your margin level will be 0. Your margin level is very important. Forex brokers use margin levels to determine whether you can open additional positions. Different brokers set different margin level limits, but most brokers set their limits at 100. Okay, this means you can't go below 100. That's the limit. This means that when your equity is equal or less than the used margin, you will not be able to open new positions. If you want to open new positions, you will have to close the existing positions first. So let's say you open up a long USD JPY position of 1 mini lot, which is 10,000. So let's say you have an account balance of 1,000. That's your balance, 1,000. So how to calculate the required margin? You want to go long on USD JPY, and you want to open 1 mini lot of 10,000 units position. The margin requirement is 4%. How much margin requirement is needed? So you will need to open this position. Since the US base currency of a mini lot is $10,000, which means the position of that notational value is 10,000. So the required margin in the notation value, the required margin of this is your notational value, which is 10,000 times the margin requirement will give you your required margin. So your notational value is 10,000 times the margin requirement, which is 0.4%, will get you $400. So assuming that your trading account is denominating in USD, since the margin requirement is 4%, your required margin will be 400. Okay, so your required margin to open at that trade for USD JPY will be 400. So to calculate the use margin, aside from the trade we would just enter, there aren't any other trades. Since we have a single position open, your use margin and yours is the same as your required margin. Your required margin. So your use margin and your required margin is the same. Your balance is 1,000. To calculate the equity, let's assume that your price has moved slightly in your favor. Your position is now trading at a break even. This means that your floating profit / loss is 0. Let's calculate the equity. So equity equals your account balance plus your floating profit / losses. So you have 1,000, and your equity is 1,000 because you don't have any trades open, so you don't have any floating profits or losses. That's 0. So your equity and your account balance right now are the same until you open up a trade and you have any floating or profit losses open. So your equity in your account is now 1,000. So let's calculate your margin level. Now that we know what our equity is, we can calculate the margin level. So the margin level equals your equity / use margin times 100. Alright, so to calculate your margin level, now that we know that the equity, we can calculate the margin level. So your margin level equals your equity / your use margin times 100. So it will be 250. So 1,000 divided by 400, which is your use margin, times 100 gives you your margin level of 250. So that's 250%. Okay, so that's your margin level. Once your margin level goes, which is really good, you want your margin level to be at 200 or 250%. Once your margin level goes to 100%, you're in trouble. So your use margin and your free margin, your use margin is 400. You have free margin. Your free margin is 1,000. To get the free margin, you will minus the equity minus the use margin will get your free margin of 600. So your margin level is at 250 right now. If your margin level is at 100% or less, most trading platforms will not allow you to open new trades. Okay, if your level reaches below 100, you can't open any more trades. Okay, so this is why you need to understand margin level. It's very important. In this example, since your current margin level is 250, which is way above 100, you will still be able to open up new trades. Imagine your margin level as being a traffic light. As long as your margin level is above 100, then your account has a green light and you can continue to open up new trades. So let's recap on this lesson. We learned about the following. Margin level is a ratio that's between equity and use margin. It expresses the percentage. For example, if your equity is at 500 and your use margin is 1,000, you divide 5,000. You do 5,000 divided by 100, it gives you a margin level of 500. And you times that by 100, you get a margin level of 500. So in the previous lesson, we learned what margin trading is. We learned why it's so important to understand how you use margin in your account works. What is your balance? Your account balance is your cash you have available in your trading account. What is your unrealized and your realized profit / loss? It's known as how you profit. It's also your profits and losses that affect your balance. Okay, that was your realized and unrealized profit / losses. What is your margin? Margin required is the amount of money that's set aside to lock up when you open a new position. What is your use margin? Use margin is the total amount of margin that's currently locked up to maintain those open positions. What is equity? Equity is your balance plus your floating profit / losses of those all your open positions. What is free margin? Free margin is the money that is not locked up due to open positions and can be used to open new positions. So we just learned about margin call levels. We're going to talk about that next. Alright, gang, it's your boy Nature, aka Nature. Gang.